Welcome back to the portfolio, everyone. And today we're going over the top 5 utility stocks you can buy right now if you're looking to add some stable dividend income to your portfolio during this time of market uncertainty when there may be a stock market crash coming up. Of course, you don't know if a crash is coming or when, but for people who are scared or fearful that their other companies may go down in value, utilities tend to be a safer, more stable company to hold during a market downturn. So we take a look at this article here. It just talks about why utilities actually tend to do okay during recessions. And it talks about how, of course, the need for electricity to power homes and businesses means utilities enjoy stable demand. Utilities can also be solid investments during times of ultra low interest rates, like we are currently seeing right now, because they tend to offer a reliable dividend payment to investors searching for yield. Of course, with low interest payments, utilities are very highly capitalized companies who use a lot of infrastructure in order to generate revenue. And if the fact that they can go and get money from financial institutions for such low interest rates allows them to build new infrastructure and grow their operations. So times of low interest rates actually are very beneficial to utilities right now. And what we're seeing right now with some of the lowest interest rates we've seen in years, utilities may actually have the ability to thrive and grow during this downturn. So today we're going to go over the top 5 utility stocks that will provide you consistent dividend income even if we do see another downturn of 20 to 30% in the market, which may or may not be coming very soon. But before we do that, we're going to take a quick look at how my portfolio performed today. You can see we are in the green today of over $550. Total portfolio value at $44,098, still down close to over 11% overall, which is close to $5,000 in the red on this portfolio. If you have been following along with my portfolio, I have started this at the beginning of 2020, so I did buy in at pretty high prices, and we did see that market decline, which is why my portfolio is somewhat pretty much significantly still in the red. Before we jump into stock pick number 1, I would like you to please like and subscribe. I am the Gen Z investor, and every single day I come up with new videos that talk about the stock market, different stocks for you to buy, and overall stock market news and headlines. So the first stock we're going to take a look at today is Nextera Energy, ticker symbol NEE, currently trading at $238 a share, slightly up today, close to 1%. On the 5-year price chart, you can see very nice price appreciation at close to 140% over the past 5 years. Nice solid upward trend. If we take a look at the 1-year chart, you can see here that they have not fully recovered from their pre-pandemic levels, which may make this a nice buying opportunity if you believe that this company can reach new highs into the future. Market cap at around $115 billion with a starting yield at 2.37%. So of course, with these utility companies, we're looking for that safe, consistent dividend income. We want this dividend income to grow each and every year. We're not expecting a super high dividend growth rate from a lot of these companies, but we're looking for that stability and consistent increases during market turns where the market may be in the red. We want our dividend income from these utilities to keep coming in each and every quarter. So we take a look here, starting yield at 2.37%. A very nice dividend payout ratio of around 61.6%. Very sustainable, gives it enough room to continue to operate and invest back into the business, as well as raise that dividend over time. Beautiful 11.5% 5-year dividend growth rate. So for a utility company, this is a very nice dividend growth rate. And you can see here for some utilities that we're going to take a look at are yielding close to 4% starting with slower dividend growth. So Nextera Energy is a little bit of a lower starting yield, but with nice dividend growth that's going to help the compounding effect moving forward. And they have become a dividend aristocrat with 25-year dividend growth history, which means they have increased their dividend through the 2008 financial crisis, and in the 2001 internet bubble, they have continued to raise their dividend through those little bumps in the road and continue to increase it each and every year. And of course, when we take a look at their dividend safety score, they have the highest rating of 99, being that dividend is considered very safe and probably not going to be cut anytime soon. The second utility stock on the list is ticker symbol D, Dominion Energy, currently trading at just over $80 a share. Once again, nice little one-day increase of around 1%. 5-year price chart is up around 18%, so slower growth on the price chart, but you can see here if we take a look at the 1-year chart, it is up 4% and has not fully recovered to pre-pandemic levels. So once again, maybe a nice buying opportunity if you're looking to enter or add to this position. Market cap at around $66 billion with an amazing starting yield at 4.72%. So if we take a look at the dividend tab here with that nice high starting yield at around 4.72%. Much higher payout ratio at around 86%. So for utilities, some of them I do allow them to cross my threshold of 75% payout ratio, only because they operate in such a stable business where they have such predictable income coming in. I do believe they'll be able to manage their dividend properly, with a beautiful 5-year dividend growth rate at around 8%, with a 16-year dividend growth streak. So a nice starting yield matched with nice dividend growth around close to 9% on the 5-year average. With a history of consistently increasing their dividend, this may be another utility stock you want to add to your portfolio for that consistent income during a downturn. Their dividend is considered safe, ranking in at 75, and as you can see here, they have a beta just around 1, so somewhat volatile. And on the last year, their growth was slow last year, but of course, on the 5-year average, they are close to 9% on average dividend growth. The third stock on this list is ticker symbol DUK, Duke Energy Corporation, trading similar to the last stock on our list, around $80 a share. Once again, slower price appreciation on this stock at only 11% on the 5-year chart, with a nice starting yield at around 4.8% and a market cap at around $58 billion. Moving on to their dividend, you can see that nice high starting yield at 4.8%, sustainable average payout ratio at close to 74%, giving the company a little bit of money to reinvest back in the business, but enough money left over to grow that dividend moving forward. Nice 3.52% dividend growth rate over the past 5 years. So that's not the best, not a high growing dividend, but at least your dividend income is coming in and meeting or beating inflation each and every year with those dividend increases, and a 9-year dividend growth streak on this stock. Their dividend safety score is at an 80, so their dividend is considered safe, and the company is going to continue to pay that dividend moving forward if nothing else continues or changes within the company. The fourth utility stock on our list today is ticker symbol AEP, American Electric Power Company. 5-year growth chart of the price of the share is up over 47%, so nice price appreciation. And if we take a look at the 1-year chart, you can see they have not recovered from and reached pre-pandemic levels, so there is a lot of growth coming back to this company if they are able to get back to those pre-pandemic highs. If we take a look at their dividend, you can see a nice starting yield at close to 3.6%, very low, very sustainable payout ratio at around 65%. That 3.6% starting yield combined with a 6% average dividend growth rate over the past 5 years allows that compounding effect to grow very nicely within your portfolio, and that dividend income is going to grow at a faster rate than inflation. A 15-year dividend history shows that this company can consistently raise dividends even through small recessions like we saw in 2008. The dividend is ranked very safe at a score of 81, so very unlikely that this dividend gets cut anytime soon. The fifth and final stock on our list for best utilities to hold during some market uncertainty is ticker symbol SO, the Southern Company, trading at $51.56 a share. You can see here they have somewhat slow 5-year price appreciation on the share price at around 20.5%. You can see here market cap at just over $53 billion, with a starting yield, the highest of all the utilities on our list, at around 5%. So when you get that nice 5% starting yield, they have a pretty high payout ratio at around 81-82%. So they do have enough money to reinvest back in their business, but they are putting around a large chunk of their earnings and paying it out as a dividend. You can see here, slower dividend growth company, but only around a 3.45-year dividend average growth. But with that lower yield, you can see you're getting a high starting yield, so the CAGR is close to 9% with an 18-year dividend growth streak. And we take a look at how safe this dividend is considered. It is the lowest ranked dividend safety score of the top 5, but it's at 65, so it still is considered safe, but not as high as the first 4 picks on this list, which is why I did throw that one at the end. So those are top 5 utility stocks you can take a look at right now if you were looking to add to that utility sector in your portfolio. Utilities typically are safer, more stable companies during market downturns just because of the consistency of their income. People still need to pay their monthly utility bills. It's it's always a necessity, and that's what people usually put their money towards before they go spend it out on luxuries. So these are the companies that are going to continue to generate revenue even when the economy does slow down, which we are seeing right now. So I do believe if you need some to add to your portfolio, utilities may be nice to have some consistent income that If you look at these dividend safety scores and let's take a look at their financial statements, you can see that the first 4 companies on this list are probably very unlikely to cut that dividend. Number 5, Southern Company, does have the lowest dividend safety score, but their dividend is somewhat safe, so they may not cut that dividend as well moving forward. But of course, always do your own research, check out these companies on your own, and I will see you in the next one.